Hello everybody, welcome to the Trading Bootcamp series, and in today's episode we are going to learn about ICT and his fair value gaps. Now, to start things off, if you guys don't know what is ICT, I already explained in the change in stated delivery video, so if you want to see that, go check that video out, and let's start things off. So fair value gap, as the name suggests, is a gap in price action. Now, how do you mark this gap in price action? It's from this, let's start with this example. It's bullish. So let's start with this. So you mark this fair value gap from the first candle stop wick or body if it doesn't have a wick. So for example, if you have a up candle that closes with no upward wick, then you mark out with the body. But if most of the times, that is basically what happens, you have a wick of price, so it's from the first candle's wick and the third candle's bottom wick. So in this example, since this is a bullish example, it's from the first candle's stop wick from the third candle's down wick. So it's going to create this gap, and you can mark it out with a rectangle. We'll look at some chart examples after, but this is just to check things off. If you guys know what is a fair value gap, I'm just here teaching the basics and stuff. Now, what does the fair value gap actually do? Fair value gaps are points of interest in the market. So markets oftentimes go up and then maybe retest these fair value gaps and go back up, and for this example, right? But now there are times where fair value gaps that get disrespected, and this happens frequently. It's not a rare occasion. This happens frequently. Now, this is called an inversion fair value gap. The inversion fair value gap is when you have the fair value gap, which in this example is bearish, so it's going to be this one. You're going to mark from the first candle's bottom wick up to the third candle's top wick. That is going to be for your bearish fair value gap. And then an inversion fair value gap is when you have a candle body closure above the first bottom wick. Now, why does it have to be a candle body closure and not just a wick? Because a candle body closure above the fair value gap means that this entire zone has been disrespected, right? And since this is a POI, which in this case is bullish, let's use this bearish example because we have this one right here. So let's use this one. So this POI, since it's a bearish example, right? Many sellers since this is the impulsive move and this is the gap, price will often retest this and go back down, right? This area is where a lot of sell orders, is where a lot of passive players stay in, right? And then if mostly aggressive buyers, if they step into the market, right, and close above the sellers imbalance, it basically means that the sellers got disrespected, therefore they're losing momentum in the markets. So what does the inversion fair value gap actually mean? The inversion fair value gap means that sellers, in this case, are losing control. Why are they losing control? Because you have the candle body closure, suggesting that price is either going to switch direction, right, which is the most plausible, and honestly the first thing that it will happen is that you will actually see a trend switch. Now, as you can see right here, inversion fair value gap can also be a point where price actually tends to go down into retest the zone and then go back up. If you combine it with the Fibonacci, which is a thing I will be teaching later in future videos, it may be a good entry. Now, here in this example, why do you have to, I already explained it. I'm just going to give you an example of why this isn't versus why this is an inversion fair value gap, because this is really, really important. And I see a lot of traders that get either messed up with this or get confused. So I'm here to teach and I'm here to help. So let's start things off. So you can see right here, this is a bearish fair value gap. As you can see, marked from the first candle's bottom wick to the third candle's top wick. That's good. You have this bearish fair value gap, and now this is not a inversion fair value gap. Although you had this bullish impulsive move, it did not fully close above this fair value gap. So this means that sellers are still actually in control, right? Because price could not reach this, because if this would happen, that would mean a different story. But since sellers took control of the gap, since sellers took control of the POI, they actually brought price down back once again, as it should have been. So this was actually a retest to the fair value gap. So you have to pay close attention to this. And this one is valid because it closed above, right? That is the only thing that you have to learn about this stuff. So let's see some chart examples. Let me put something. Wait, I got these alarms right here from my trading. Let me see in the 15 minutes. So I haven't mentioned this. As you go along with the time frames, since there is more data, the fair value gaps become more powerful. For example, the 1 minute fair value gap is going to be less powerful, a lot less powerful than the 15-minute fair value gap. For example, we are in a 15-minute fair value gap. So let's see what happened right here. So as you can see, price created this fair value gap. How do you mark this? This is a bullish example. How do you mark this? So you have to say with me. So you mark this from the first candle's top wick to the third candle's bottom wick. Yeah, that's the bullish. So price delivered. Then we had this point of accumulation. Then it manipulated down into this gap. And as you can see right here, this was a manipulation and not an inversion for value gap. This was not a bearish inversion for value gap. Why? You see these wicks? They did not close above. So price, the candle was once like this, almost closing, right? Price, the candle could have closed right here, but it didn't. And they manipulated back up because buyers took control once again of this point of interest, of this point of liquidity. Now, you may ask, for example, oh, then why didn't this fair value gap hold? So as I said, and as I'm clearly going to mention over and over again, gotta understand this of probability. And when you identify the real fair value gaps, when you identify the real impulsive moves, right, they become more powerful and more probable for price to manipulate and actually be good with it. So, for example, this is right here, as you can see, what I told you in the beginning. So the inversion fair value gap can also be a point where price tends to go back up and then go back down. As you can see right here, we had this bearish inversion fair value gap. Price touched back in, almost closed above, creating that inversion, almost happened, but then it manipulated back down to this fair value gap. Right, so now let me teach you two things that I want to clear right here. So let me try to find, because I don't want to draw. It's going to waste a little bit too much time for this. So okay, so you got this right there. No worries. So this fair value gap. Why is this fair value gap different than others? Or why is even this one that I marked out different than others? For example, this one. So you got to understand the candle theory. So I already teach that in the first video. I think it was the first Trading Bootcamp video. So what is candle theory? So you see right here, this was actually an absorption and a buyer absorption candle. Why? You see this top wick? Yeah, sellers took control right here of price. So yeah, so what do you want ideally, what is the best fair value gap form you can have? For example, you can have impulsive moves like these ones. For example, you got this big candle, another big candle, another big candle. These can just be impulsives, and these are way less likely for price to hold and actually manipulate into, right? So therefore, these ones, what do you want to have? So you want to have the first candle, you want to have this little or this little big candle. So you never want the three candles to be always impulsive. You want the first and the third candle to be a little bit tiny or a little bit not as impulsive as the first one. For example, this one, we had this tiny impulsive move to the upside. Then we had this tiny candle, as you can see, this tiny body. And this second candle was actually a very impulsive move. This is actually the best fair value gap form you can ever ask for, basically. And yeah, as you can see, boom. Now, another thing I want to talk about, it's different types of imbalances. So this is NASDAQ. This is a little bit more complex, but I'll just give you the introduction so you can keep in mind when I'm going to talk in the previous videos about this. Wait, is it previous? Shit, I got a blank. I got a blank. It's not previous. Damn, I forgot. Oh, I'm so dumb. All right, I think when there's in future videos. Sometimes my English forgets. Fuck, bro. All right, so in future videos, I will mention this even further, but just to keep your mind straight ahead for what you're going to learn. You're going to learn the sessions. So you have the London, New York, and Asia session. Now, Asia session tends to accumulate. London session tends to distribute or manipulate, and New York tends to manipulate or distribute equal to London. Now, this is in the NASDAQ. NASDAQ is the 100 top companies from the S&P 500. So it's the top 100 companies, tech companies from the S&P 500. What is the S&P 500? Is the top 500 companies from the United States of America. So yeah, when New York session hits, this is like this impulsive move. You see, as you can see right here, 9:30 open, you get this big move to the upside. This is called New York session. Now, why is New York session better with NQ? Because NQ is 100 US companies. So when US liquidity starts riding in, you bet it's going to be good. So yeah. So impulses for value gaps, basically impulse moves, when they are formed by New York, for in this example, because I'm trading NASDAQ, in this example, when impulsive or fair value gap moves happen during New York, they are basic displacements. What does that mean? That means that these moves that have such volume, have such liquidity, right, that price usually tends to pull back with force and then aggressively manipulate back up. As you can see right here, you have this gap created by New York. As you can see right here, 11, it's still New York. And then you have this huge wick up, right? Because these have such large orders, such large liquidity, right? That price just goes back down, manipulates, oftentimes with the wick or with the body, preferably with the body, and then pow, explodes back up for this example. So yeah, that is the main thing you want to learn. And so we covered the basics. We covered what is the fair value gap. We covered everything. And yeah, that is the basic stuff you want to learn, and you have to learn, okay, because this is very, very important. These fair value gaps are very, very, very important to learn. Keep in mind, you have to learn, and not just from this video, go watch other videos explaining fair value gaps even more, because this is just the introduction, basically. So go watch other videos about fair value gaps to even revise you if you already know these, because these are the main components of the markets. These are what creates markets, basically. It's impulses. If the markets just accumulate, why would you even trade, right? So you have to have impulses. And the impulses, the gap of the impulse is marked by these gaps. So really study this, really focus this. And yeah, so this is the end of the video. I will be posting the trading recap on Monday or Sunday. I don't know right now. I'm not sure. But yeah, that's it for me, guys. Have a blessed night, and God bless you, man.